What would happen to your financial future if you just stopped investing for 5 years? Would it really matter that much? The truth is, 5 years off might cost more than you think. From missing out on market growth to falling behind on life goals, this pause can leave a lasting impact. Today we're uncovering the hidden costs of stopping your investments. The power of compound interest. Compound interest is one of the most powerful tools in building wealth, and time is its best friend. When you invest, your money earns returns, and those returns start earning their own returns. That's what we call compounding. If you stop investing for 5 years, you're not just missing out on your contributions, you're also losing the future value that those investments could have built. Take someone investing $500 a month starting at 25. If they pause from 35 to 40, they could lose over $200,000 by age 65 depending on market performance. This happens because compound growth increases exponentially, not linearly. The earlier you start, the more powerful your money becomes over time. When you pause, even temporarily, you lose valuable growth time that can't be recovered easily. Each dollar you don't invest today costs you more than you realize tomorrow. That's why staying consistent is so important. It's not about how much you invest, but how long you let it grow. Time multiplies your efforts in ways that are impossible to recreate later. How inflation reduces your savings. Inflation might seem small each year, but over time it eats away at your money. If you stop investing and simply keep your cash in a regular savings account, you're actually losing value every day. Inflation has averaged around 2 to 3% annually, though some years are much higher. So let's say you have $50,000 saved today. In 5 years, with 3% inflation, that money will only buy you what about $43,000 would today. That's a real loss of purchasing power even though your bank balance hasn't changed. Investing helps your money grow faster than inflation, so it keeps or even increases its value over time. Without those returns, you're essentially moving backward financially. A 5-year pause in investing doesn't just pause your gains, it exposes your savings to gradual loss. It's a silent erosion that many people overlook. Inflation never stops, so if your money isn't growing, it's shrinking in real value. That's why sitting out of the market for even a few years can be more damaging than you might expect. Missed market growth opportunities. The stock market is unpredictable in the short term, but has consistently grown over the long term. When you stop investing for 5 years, you risk missing out on major growth periods that could dramatically increase your wealth. Historically, some of the biggest gains happen during brief windows, often right after downturns. For example, the S&P 500 rebounded massively after both the 2008 financial crisis and the 2020 pandemic. Investors who stayed in saw huge gains. Those who pulled out missed the recovery. If you take a 5-year break, you might sit out a bull market and lose your chance at major returns. Even missing just the top 10 best days in the market over 2 decades can significantly lower your total gains. Timing the market is nearly impossible, and waiting on the sidelines usually does more harm than good. The longer you're out, the more chances you lose to benefit from growth. Staying invested, even during uncertain times, keeps you in the game and ready for those high-return moments when they come. Falling behind on goals. Taking a 5-year break from investing can seriously derail your long-term financial goals. Whether it's buying a home, saving for your kids' education, or retiring early, all of these plans depend on steady investment over time. When you stop, the gap that forms may force you to either contribute more later or delay your goals altogether. For example, if your target was a $1 million retirement fund by 60 and you stop investing in your mid-30s, you could fall tens of thousands behind. To make up for it, you'd have to either save a lot more or work longer. That means making uncomfortable trade-offs, like pushing back retirement or scaling down your lifestyle. It's also harder to catch up than it is to stay consistent from the start. Life won't stop just because your investments did. Your goals keep getting closer, and time becomes more precious. Skipping even a few years can make you play catch-up when it's least convenient. That's why a short pause can lead to long-term setbacks if you're not careful. Emotional effects of pausing. When you stop investing, the impact isn't just financial. It can be emotional and behavioral too. Investing consistently builds discipline and a growth-focused mindset. When you stop, it becomes easier to fall into bad habits like spending more freely or delaying financial planning. That 5-year break might lead to fear of jumping back in, especially if the market is volatile. You may also feel behind, which creates stress or regret. Trying to catch up later often pushes people toward riskier investments in hopes of fast returns. That can backfire and make the problem worse. Behavioral finance shows us that consistency is one of the key drivers of investment success. Just like a gym habit, taking a long break makes it much harder to get back on track. You lose momentum, motivation, and mental focus. The emotional toll of pausing isn't always talked about, but it's very real. Once you stop, getting back into the right mindset and discipline takes time, effort, and often a lot of courage. Cost of restarting investments. Getting back on track after a 5-year break sounds simple, but it's harder than most people think. If you've taken time off from investing, you'll probably need to invest more each month to reach the same goals. And that adds pressure. Let's say you plan to invest $500 monthly for 30 years. A 5-year pause might mean you now need to invest $700 or more to catch up, assuming the market does well. If not, you could fall even further behind, and you miss the benefits of dollar-cost averaging during the missed years, which helps smooth out volatility. Trying to speed up results can tempt people to go for riskier assets, which increases your chances of losses. Restarting also requires strong discipline. You're now under more pressure and the emotional strain is higher. In many cases, people simply can't or don't make up for lost time. That's why staying invested, even at lower amounts, is usually better than stopping completely. Momentum matters in investing, and catching up later often costs more than just staying steady now. As you've seen, a 5-year break in investing can set back your financial future in more ways than one. From missed growth to emotional setbacks and delayed goals, those lost years are more costly than they appear. The best path is consistency, even if you're only investing small amounts. If you found this video helpful and informative, please hit the like button, subscribe to our channel, and share your thoughts in the comment section below. Thank you.